We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chase Taylor, global macro strategist and editor at Pinecone Macro Research, and also the head of research at Bulwark Capital. How are you today, Chase?
I'm doing great. Thanks for having me back on, Tom.
Always great to have you, Chase. And, it's been a little while since we caught up. But in your most recent report, you went into a bit of an examination of what, you got right and what you got wrong in your views over the past year. And I think it's really interesting to look at that and understand and learn from times like that. I think there's, a lot of analysts that are in the same position of getting calls wrong in this, in a lot of ways, unprecedented environment. But I think that value really comes from the examination and the subsequent lessons learned because of that. So maybe if we can we start by talking a little bit about what you feel that you got wrong over the past year and what were some of the lessons that you pulled out of that analysis?
Yeah, sure. So I think it's crucial to always be doing postmortems on things you get wrong, but also I would say equally important is when you get something right, but in reality you got it right just because you got lucky. I think those are also very important times to go back and kind of like really take notes and go deep on what happened. But in the last year, got some stuff right, some stuff wrong. When it comes to getting things wrong, it was really getting bearish on the real economy and kind of the macro cycle too early. And looking back on that, at least what I think I got wrong is I've kind of come up with this phrase and this kind of catchy thing of the lag reaper, where I think the lags in the economy are actually longer than normal. So the Fed kind of seems to think they're shorter than they used to be. I think this cycle especially, it's longer than it used to be. And really the creation of the lag reaper was me doing a deep dive on how I got the lag things wrong. So I was expecting shorter lags, but kind of looking back on it's one of those things where it's like kind of embarrassing to even look back on, because when you think about throwing $5 trillion at the economy, like of course there's going to be a long lag because you have to work through that $5 trillion, which we're still to this day kind of working through. So the consumer had a bunch of money, corporates were fine, like everyone refinanced at nothing rates, and they had a bunch of extra cash laying around. So that was just perfect fuel to not only have a longer cycle and a longer lag, but really to sort of set a trap for the Fed to overtighten, because they're sitting there making policy decisions that are going to impact what happens in the economy a year from now, 2 years from now, while looking at data that really is relevant to what happened a year ago, while looking out the window to see if it's working. So they're going to sit there and raise rates 75 basis points, and they're going to look out the window and say, well, jobs aren't going down, so let's do it again. When in reality, those 75 basis point hikes don't get really felt for maybe a year and a half, something like that. So, but I was falling for that same thing, call it a year ago, 9 months ago. I thought they would have problems whenever they got rates up to about 3%. And I still maintain to this day, I think every hike above 3% was really over tightening. But that was the biggest stuff I got wrong, was kind of that length of that cycle. I would say the construction boom was another big part of this, where I didn't think construction would stay as strong as long as it has. But again, looking at home building and high rates and what has happened with existing home sales basically just going to near zero, it made new homes the only game in town. So it makes perfect sense looking back. Yeah, of course, you're going to have kind of a building boom and it'll stay strong even after maybe it shouldn't, just based on there's no other supply to be had. So the construction boom and the lag being longer than expected are the two big things I think I got wrong in the last year, and why these lags are longer.
Mm-hmm. Yeah, I think it's interesting to not only talk about that $5 trillion being dumped into the economy, but also the moratoriums, like we're going to get to, for example, with the student debt. But as you're talking about not only analyzing what you got wrong, but what you got right, I was going to ask you, have you ever read the book The Art of Thinking Clearly? Because in that book, they go through and explain exactly that, not only trying to figure out what you got wrong, but why you got may have gotten something right and understanding if you got lucky.
Yeah, absolutely. And I have read that book. It's on the shelf back here. But um, in fact, on that, everyone wants to know the great investing books to read. And the one thing I'll tell people, maybe you're just getting started out in this, read books about thinking more than you read books about investing. Like, obviously you have to read those. It's important to get a baseline. But once you get a baseline in investing knowledge, start reading books about thinking. It's way more valuable. But yeah, to your point on things gotten right and the why, and sometimes you're wrong about the why on that. But when it comes to this, we got bearish on stocks, which worked out last year, not working out this year clearly. But there was a lot that went on there. A lot of commodities were just kind of going to the moon in 2021, and we kind of pulled away. And then 2022, we got bearish on a lot of them. That worked out great. So some of the market stuff worked, but then being long fixed income, or especially SOFR early, was not helpful at all. I was expecting the Fed to have to stop, or these hikes a while ago. But the good thing there was I was positioning out in 24, 25 because I knew the chances of me getting timing right to the month or even the quarter was just going to be slim. So thankfully I traded it in a way that was able to kind of stay alive. But that's some of the stuff we got right and wrong, and just on little things we got right. And one of the beauties of markets is you can get macro wrong and the S&P 500 wrong, but then get something small right and have that in your portfolio, and it kind of protects you. We got cocoa very, very right going back to November of 2022, and so it's nice to have things like that kind of bail you out as you get some of the other stuff wrong. So
just to kind of, I guess, close the loop on that idea of evaluating your thinking, I think some of the most important lessons for myself personally were when I felt super smart about a particular investment that I made, and all of a sudden it just goes through the floor. I think those are really important lessons to, or times when you need to evaluate that type of psychology. I spoke to Lawrence Lepard the other day, and he was talking about the idea that some of his, let's say, gold investments at this time almost make him want to throw up. And he added that was an interesting time for him to reevaluate those positions from a bullish perspective because of that feeling of negativity towards them.
Go ahead.
Sorry, you go ahead.
I was just going to say, it's funny because you get to those times where something makes you want to throw up, and it's either time to cut it or it's time to do that deep dive and realize like kind of gain conviction and kind of like actually lean into it. Mm-hmm. But it also tells you, I think, sometimes it just means your sizing is wrong. If you can't sleep, or if it's making you sick, you may be right, and it may be a great trade. It may be one of the best trades you're ever going to put on, but it also probably means maybe your size is too much. So there's always a level where you can sleep okay, and that's important to find that level sometimes.
Which I think brings us to the point of timing as well, because that is, positioning properly, obviously, but timing is always one of these things that seems to be, pushed out and pushed out and pushed out, regardless of how sound your thesis might be. So, having that some type of wiggle room or optionality in that respect, I think is important to think about as well.
Yeah, and a perfect example of this is, so we did well in cocoa. We have done well in cocoa. We're still in, and really the big part of that thesis came down to going from La Nina to El Nino. That's happening. The trade's working beautifully, but you can argue that should also help things like rice, and it's really not. So again, this could easily go back to like, okay, we nailed it on this trade, but a lot of other things went right that weren't necessarily part of our thesis. Whereas, if we chose to express that trade in rice or something, then you would have had a decent trade, but not a great trade. So it's always important to kind of go back and look at those things. And it's just important to know, like, this cocoa trade didn't work because I'm a genius. This cocoa trade worked because, yes, we got some of the analysis right, but then, probably 5 lucky things also kind of jumped in and helped us out, because you can literally look at another trade you could have put on with a similar thesis and it was okay.
Mm-hmm. So why have you dubbed this summer the summer of discontent here?
Yeah. So I think there are a lot of different roads leading into the late summer, especially, that are going to have negative impacts. One of them, we just spent some time talking about excess savings and how that was a big part of the reason I was a little early on this, and maybe I still am early with saying late summer, but it's kind of becoming clear to me that excess savings has kind of largely run its course and is out of the system. If you look at core retail sales over the last 3 months, it's flat. So that tells you consumer spending is really flatlining. Obviously, you can go look at how much money people are borrowing with, whether it be credit cards or loans or whatever it is. Like, clearly people are using credit a lot more than they were. That tells me you probably don't have a bunch of cash if you're going to go put something on a credit card that charges 20%. So that's a big part of it, is not having that cash cushion left. The labor market's softening. If you just look at the last 3 weeks of jobless claims, we've broken out of this range of around 220 to 240. We're pushing up in the 260s, not recessionary, but showing that there are some cracks maybe starting to form in the labor market. And when I look at something like productivity numbers, that tells me there's literally too many people out there on payrolls, and companies just don't want to let them go because they just had to go through the Hunger Games to get them. But at the same time, if your new orders are collapsing, you don't have a backlog, and you have 10 extra employees, like, at some point it's going to make sense to let them go. But you can look through a lot of survey data that makes it pretty clear companies are like, yeah, things are bad now, going to get way better in the second half. So it makes sense to hold on to these people. I think whenever what I see coming, if it happens and people have to accept that the second half isn't going to be as rosy, that's when people will finally kind of let go of some employees. And I even think there's going to be a tipping point where, when a few people let go of employees and that headline non-farm payrolls number goes red, which I think is possible in August, there's like a tipping point where, if everyone else is going to do it, you may as well do it, because you don't have to fight to get them back if everyone else is letting people go. So I think that could be kind of a nasty issue for employment in the second half of the year. So you have employment as one of these catalysts for the summer, the excess savings kind of going away. But then on top of that, we're going to have student loan payments coming back up. That's going to be obviously a significant problem. You're talking about the average payment of $400. We know from the data that the people that owe this money, their credit is in worse shape than it was before they were told they didn't have to make these payments. They filled in that debt hole with new debt. So a lot of people, have $700-800 car payments, and they're already struggling to pay. We can look at the delinquency data, and for young people, call it under 40, their delinquencies on things like cars are already like the highest they've been since the financial crisis. And clearly they have a job. If you look at jobs data, like, people have jobs and they're still struggling to pay on things like credit cards, personal loans, especially automobiles. And you're also going to throw this, this new student debt payment on top of that. And that's not one you can just say, hey, I'm not going to pay you. Like, the IRS can come after your income taxes. They can garnish your wages, all kinds of stuff. I'm not saying they will do that, but they can. It's not the same as just not paying your credit card anymore. When we really haven't had like a significant default cycle since the 08 crisis. 2020, I mean, at the end of the day, the consumer was way better off during that recession than they were before it. So none of us are really even, we all like to talk about, like, well, none of us remember what it was like in the 80s or 70s, but none of us really remember what it was like in 07, 08, 09 either. So I think just having a normal default cycle is going to be a big problem, with a lot more leverage in the system. The role and the size of private equity and private credit has grown extensively since 08, and we don't really know how big the risks are there. So yeah, I just think between I think the consumer has a lot of significant headwinds, and I think those are starting to pop up. A lot of people are going to either lose their jobs, or at least you're going to go from this like confidence to go and ask for a raise, or confidence you'll get a new job if you lose your current job. And I think that's largely going to be gone by the end of the summer. And at the same time, when I look at the credit data, M2 going down every single month, I think money and credit are going to play a role here as well. So it's just a lot of different things kind of all coming together. And it all kind of like starts to really hit this summer. Some of it's already happening, but I think that July, August period, it's just going to keep getting worse.
Mm-hmm. So I'd still like to kind of separate all of that at some point here, Chase. But,
Sure.
you know, all of those things considered, does that give you the feeling that we're facing a recession in, let's say, the second half of this year? And why do you think it was maybe delayed for as long as it has been? Because there was a lot of talk about this expectation for a recession far before we got to this 5.25% Fed funds rate.
Yeah, definitely. I think the reason it's taken longer than we thought is construction has stayed so strong, and the fact that the consumer's been held up by those excess savings, and hey, employment's been really strong, so that it's difficult to have a recession when people are still hiring, and we had a lot of areas of the economy like business or like leisure, hospitality, things like that, restaurants that, I mean, they were just nowhere close to being filled up on hiring back to kind of those pre-pandemic levels. So they just kind of had to finish getting there, and that took some time. And obviously, nominal incomes are just kind of steadily going higher as more and more people enter the workforce. So it's difficult to have a recession on an aggregate level whenever all that's going on. But at the same time, you were sort of trading, software engineering jobs for waitress jobs at the end of the day. And that's why we see GDI having gone down for 2 quarters and seeing a ton of income being revised out of BEA data, and jobs actually being revised out of the data in the fourth quarter. So it's this weird thing where all of a sudden the government's looking at their data and saying, like, that's weird. Like, it seems like everything's like on fire, but incomes are going down. Well, yeah, I mean, almost all the jobs that you've added in the last 6-9 months have been low-paying services jobs, which is great, but that makes it difficult on an aggregate level if you're also losing some high-paying jobs. So you sort of have like a white-collar recession that's awkwardly rolled into this thing. That's kind of like the why I think why it's taking this long. But as far as are we going to have a recession still? Yeah, absolutely. I think, yeah, if you thought 4.5% rates were going to be bad, like, trust me, 5.5 will be bad. But it just takes time to work through balance sheets, to work through companies in order to create stress. A lot of companies, anyone that can have any sort of fixed rate financing, they fixed their rate, they refied in 2020, 2021 when rates were nothing. So, and there's a lot of extending out on maturities. So whether you're a corporation or a person that, refied your house, like that helped you, get through a lot of pain. But at the same time, if you're a company that's dealing with floating rate debt, and a lot of the trillions of dollars of debt from companies in America are tied to floating rate debt. They're just tied to SOFR, LIBOR, whatever. And they're starting to really feel the pinch. Defaults are piling up. We just recently had about an $8 billion default. Like that's significant. We've had, I think, 40 something defaults, 300 and something bankruptcies this year. Like all this stuff is kind of hitting multi-year highs. None of it's crazy yet. Default rates are, not wild or anything yet, but we're getting there where, you may have a company and maybe you have a plan to like weather a storm for a year. And if rates pop to 4 or 5, that's fine because we have this buffer here. We can pull this lever over here and this one over there. It'll be fine. But most people don't have a game plan for 5% rates for 2 years. Like that, if you have leverage, then and you have floating rate debt, or you have maturities you have to roll over in that window, like you don't get to play anymore. So I think those companies that stuff starts to float to the top here soon, especially with you're not going to get access to credit from banks. And you're not going to get anything from like a CLO backed loan or anything like that, because CLOs can't buy much anymore because too much triple C's are hitting the market.
Can you just define GDI quick for us?
Yeah. So we all know GDP, gross domestic product, but GDI is gross domestic income. Okay. And it's a way of kind of viewing growth through the income side instead of the production side. And actually, NBER really leans on it for recession calls more than people realize, I think. So it's hard to have a lot of growth without a lot of income. So we've had a weird divergence between production and income lately, where GDI has actually been kind of rough and GDP has actually been solid. But if you average those two together, which a lot of people do, a lot of cycle analysts will just kind of smush them together and watch that, moving average, and that looks pretty weak. So it's something I track because I think there are the people that are on the other side of my thesis that think, hey, like we may be reaccelerating here, don't see a recession anytime soon. A lot of really anyone that thinks that is they're viewing this cycle as being driven by incomes, so that the income itself is kind of like the horse pulling the cart. I think that's backwards, but that's their view. But even if you have that view, when you see GDI contracting, you see like these income numbers being revised down in a big way. Like to me, that tells me like, well, that if that's your thesis, then your prime mover for the cycle is weakening too. Something I like to keep an eye on, and all like bulls, people that think we might reaccelerate or that things are fine, tend to really anchor to nominal GDP lately. I've noticed like they'll all talk about how strong nominal GDP is. You can't have a recession if you're having 6-7% nominal GDP. It's hard to get rid of inflation, yada, yada, yada. But to me, you can take the nowcast that the Fed creates for both growth and inflation, and you can just essentially create a nominal GDP nowcast that way. And it's just falling off a cliff, and it's back to pre-pandemic already. So I think wages are going to keep coming down. I think employment's going to come down. I think growth comes down. I think earnings estimates for the back half of the year, and especially in 2024, are essentially extrapolations of the pandemic demand shock and a stimulus shock. And to me, that it doesn't make sense to me. I would love to have someone explain to me how retail stocks can have the same earnings they had in 2020 and 2021 and 2022, years out into the future, instead of the kind of pre-pandemic trend without stimulus.
Mm-hmm. Chase, on that point about the data that the Fed uses, is it using, let's say, the best data, do you think, that it could, to be looking at these metrics of the economy and making those decisions based on that data? Is it using the right metrics, do you think?
Absolutely not. So a project we've been doing is to go back and look at the transcripts from the Federal Reserve in prior cycles. And we've been doing a giant one from 06, 07, 08 to see like, what were they saying? Because each one of these meetings will be 100, 200 page transcript. And not to mention all the little conference calls they had when things got weird in 07 and 08. But so we're reading it word for word to like really get a grasp of this, to see what the similarities are to this cycle. And the similarities are striking and frankly scary, because even when you go back to a month or two before the recession, they didn't think they'd have a recession. I mean, they're talking about CDOs blowing up and banks blowing up, and they're like, yeah, but man, core inflation is really scary though. So let's just chill out, or maybe we need to raise again. We're definitely not cutting, like all the way through. And so if like looking back, what was going on in 07, what was about to happen, and they're seeing all these credit stresses and problems in housing, and they're like, yeah, but housing will rebound, it's fine. Or like subprime small, that was a big thing that's gotten famous.
I was going to say that there's that famous clip of Ben Bernanke saying that there's no problem in the housing sector. Maybe a couple small issues that regional banks can take care of.
Yeah, Janet Yellen called for a soft landing 3 months before we went into the recession. Like, so you read through all that, and it was the same thing back then. They're looking at lagging data, which largely is they're going to look at the non-farm payrolls number, just say the jobs report that we all look at, which is very lagging at the end of the day from a cyclical standpoint. And they're looking at core inflation, or these days it's been super core inflation, which strips out housing and food and energy, things like that, because those are volatile and they don't really capture trend. They don't capture what wages are impacting. Because at the end of the day, the Fed really anchors on the Phillips curve, and they think that how tight the labor market is what's really driving inflation. That's just not right. That's what creates these policy errors, in my view. They hold on just full scale. They don't look at things like the yield curve or leading economic indicators, things like that. They just ignore them. So in fact, you go back and read the transcripts, and they come up with all kinds of clever ways to tell you, or to tell themselves, and I guess these transcripts, that, oh, there's no reason to look at the yield curve for this reason and this reason and this reason. You go back and look at them, and like, wow, those are absurd reasons. But they do it today. Jerome Powell has his own reasons for like, oh yeah, don't worry about that yield curve, and here's why. Here's why that's distorted now. It used to make sense, now it doesn't. So instead of looking at leading indicators, they look at lagging indicators, which is it's like, driving forward in your car while looking out the back window. And it's obviously that's dangerous. So yeah, I think I think they should look way more at leading indicators. That's, I think, difficult for them politically because, you go to a press conference and inflation 7%, and people are like, well, what the heck are you doing about it? And I'm like, well, yeah, but the yield curve and the leading indicators are saying that's just difficult. So they have to kind of anchor on the same things the newspaper's anchoring on, which is jobs, inflation. So they do.
Well, I mean, arguably they could be the ones shaping the narrative and leading that discussion in a way, because the newspapers and the media are very likely going to be, writing about it and communicating that narrative from the Fed to your average person, I would think.
You would think, but just remember, a year ago how much of a political hot button inflation was. I mean, it was everything. It was really changing policy and changing narratives very quickly in DC. So I think in a 2-3% inflation world, maybe you can do that. But I think in what we just had, where it got up to 9, it's very difficult to be like, don't worry about that because here are some leading indicators you've never heard of. It seems to me, and maybe it's just their academic and their modeling, their over reliance on the models they use. That could be part of it, or the fact that what it probably really is, honestly, is because they anchor so hard in the labor market from a purely philosophical viewpoint. Like that's kind of their keystone is the labor market, and at the end of the day, it's clearly a lagging indicator. But it's funny, speaking of lags, with the lag reapers, you go back and read all these prior transcripts, and they're doing the same thing now as they did back then. And that is like, you pay homage to the lag. You say, oh, well, there's lags, we got to be careful. And then they'll say, you read these transcripts, and it'll be, pick one of the governors or one of the regional Fed presidents, and they'll say like, okay, here's what's going on in my region. It's terrible. Like this bad stuff's happening. This bad stuff's happening. This bad stuff's happening. Man, we got to be careful with these lags. Maybe they're about to hit. Maybe they're hitting now. And then you get down, and they're like, but hey, I think we should raise rates by 25 basis points because inflation's bad. And that just over and over and over, when you read these transcripts, that's the playbook, which tells me like, if core inflation's high, they don't care what any leading indicator says. And if the jobs market isn't weakening enough, then they don't care. Now, what they do care about is credit problems, financial market problems. That's the stuff that will get their attention. But that stuff tends to happen after you've already broken the real economy.
So let's return to this idea of recession and how, let's say, you separate your thinking on the severity of it. Is it mostly just, let's say, the length of a recession that determines how deep it is or how dramatic it is? Or is it more a combination of, let's say, fall in GDP, GDI, employment, etc.?
Yeah, to me, the big thing is employment. And employment at the end of the day is what fires off all the feedback loops in the system that make things bad. And as far as like how long and how bad, really it comes down to policy. So if the Fed is quickly, adds liquidity and cuts rates, things can trough pretty quickly and get better pretty quickly. But at the moment, at least, it doesn't look like that's the way this is going to play out. It looks like they will stare at core inflation and they'll say it's too high, and they will be very slow to act, and minus a genuine crisis kind of situation. So my current base case is that the recession will be both long and deep, because I think they're going to be too slow to act. There's a lot of economic indicators that we see right now that, kind of in a normal cycle, they would already be cutting, and they definitely would have already stopped raising. But because, hey, core inflation's 5%, that's scary, so let's keep going. And as far as like I say, when it comes to the job losses, as soon as those begin, that hurts all the income for all these businesses, because there's less money to be spent, and then they have to let some people go, and then it's just less demand. That's when those feedback loops fire off. Which, speaking of feedback loops, the economy is a system. It's a very complex and it's a very dynamic system. None of us have our finger on the true pulse of it because it is so complex. So I think markets require a lot of systems thinking. Not viewing, it's like in the human body where you view like a digestive system and the brain. And if you view those as 100% different, you'll never get anything right. If you view those as kind of interconnected, like where your gut microbiome actually impacts your brain a little bit, things like that. Kind of a holistic view. I think you can get more things right. And the Fed 100% does not use a systems view. They use like compartmentalize each little thing, and they don't see the way that those things can spill over and create these feedback loops. Perfect example was SVB, the whole banking meltdown. It's like, fine, it's just like a few little banks, whatever, who cares? Well, yeah, but that it's just like when you go back to subprime. Well, subprime is like a tiny piece of real estate is a tiny piece of the economy, so who cares? Well, sure, but that's great until you have some stress here that turns into stress here, and then people lose their jobs, and that stress everywhere. Like you have to be able to see some of the future dominoes falling to get this thing right, and I don't think they're good at that. You go back to 2020 when they were calling inflation transitory after we just threw $5 trillion at the economy, which was absurd. And I've been a disinflationist for the last year, but I was a hardcore like, hey, we're going to have really high inflation back then. It was really obvious when you looked at the size and scale of the government programs that there's no way you weren't going to get inflation. But to me, on the flip side, I struggle to see how you don't have a recession, how you don't have credit problems, how you don't have a wave of defaults, how you don't have disinflation that surprises people this time.
Maybe just to add to adding $5 trillion to the economy, not only was it the amount that they added, but also the way that they added it too, right?
Yeah, that's a great point. And it's not one that's made enough too. And that is giving money directly to households is a completely different ball game than your normal deficit spending on buying some new fighter jets or giving some people some money to cover their Medicare expenses. Like it's very different because it will enter the economy, and especially the money that went to let's call it the bottom quartile, the people that you give them $1, they're spending $1, versus you give Warren Buffett $1 million, whatever. It's just part of his bank account at that point. He's not going to go just buy $1 million worth of cherry cokes that day, but you give the bottom quartile money that they're going to put it to work. So they did. I mean, that was one of the reasons I was very bullish oil, was because the bottom quartile, bottom half, even the money they spend is so commodity intensive. So you kind of knew, hey, like you're giving the middle class, working class people a giant chunk of money. All of a sudden, like they're going to put it to work. Things are going to get hot, and especially back then when supply was a problem for just about everything. It was kind of a double whammy. So I think people look at now. A lot of people are staying bullish or think inflation is going to stay really high because of, like, say, the CHIPS Act or the Inflation Reduction Act, like building EV plants and more windmills and things like that. Obviously, chip plants. I mean, sure, like that's mildly inflationary. That's not nothing. It does create jobs. Like that's all true. But when you compare the size and the scope of giving everyday people a bunch of money, it's just not even close to the same thing. So yeah, you're absolutely right. That's kind of a helicopter approach at the end of the day. Of just, hey, give regular people a bunch of money and let them do their thing. Like the trickle up works a lot better than the trickle down if you want to hit the real economy and you want to hit inflation.
So there was also one of the points that you made in one of your recent journals there, and you were talking about the amount of people, let's say under 40, I believe, living from paycheck to paycheck. A year ago, if I'm not mistaken, that was something like 23%, and it's almost 80 this year. Am I remembering that correctly?
I can't remember the numbers off the top of my head either, but yeah, it's something. I know one of the ones I looked at had millennials and Gen Z at 88% said they were living paycheck to paycheck. Mm-hmm. But they were also the people in the survey, the demographic group, that said they would splurge. They're asked, "Are you going to splurge this year or whatever?" And they're like, "Yes." Like, really? You're living paycheck to paycheck and you're going to splurge, and you have to pay back student loans? Okay. Like, so I think a lot of people are going to Wile E. Coyote this thing on the consumption side, or they're going to run to a brick wall until they get told no. And I think that's something that people are kind of taking for granted, is that a lot of people are going to get told no. I think a lot of people probably got used to run up your credit card debt and then roll it into a personal loan, just consolidate it. You used to be able to do that, take your 20% and roll it down to a 6, 7, 8% loan. Well, now those are more like 13% personal loans. And there's a real good chance your bank will tell you no, like full stop. So if you're a small business, you used to be able to go get a fixed rate 5%, loan to expand your business or make payroll, whatever. Now it's probably floating rate. It's probably 13%. It probably requires you to sign over your life insurance as collateral. Like it's a different ball game. So a lot of people are either gonna, sign that bad deal, or they are gonna just say no. That's why I think credit creation is going to be a significant problem, moving forward. It almost has to be.
Mhm. And
Okay.
that really goes towards that point of how these different demographics are holding the debt that they have, and also that the point of that student loan forbearance coming due in October. I spoke with Danielle DiMartino Booth this morning, and she made the point that there is, very likely not going to be any type of more time deferral for that, regardless of the political situation, because of how that was written into the
Exactly.
new raising of the debt ceiling, right?
Yep, that was part of the law, and even today, but probably tomorrow, I think we're supposed to get the Supreme Court decision on the money that was supposed to be forgiven. So a lot of people thought, hey, here's $20,000. It's gone now. You don't have to pay it back. And they might get an email in the coming days from the government saying, just kidding, the Supreme Court took that back. So you do owe that money. So, and I think what gets lost too on the student debt thing is a lot of people were either not paying down the principal, even though they're making payments, or barely paying down the principal, because they were paying such small amounts, while the interest was accruing at such a hefty clip. So it's almost like you're like a lifetime serf to your student debt.
Mm-hmm.
It's suffocating debt. And I mean, credit cards, we all think of credit cards, so much credit card debt. Well, there's $1 trillion of that. And there's about $2 trillion of student loan debt. So you're talking twice as much student loan debt as there is credit card debt. So it's not like a small number or a small repayment that's coming. It's huge.
And that's not debt that you can get away from in
Exactly.
any type of bankruptcy, right? In the
And
US.
exactly, and because of that, I think people will be faced with decisions. Well, I can't walk away from that, but I can walk away from a credit card. I can walk away from this car that is upside down by 10 grand, things like that. And I think you're going to have some credit stresses from that angle. And going back to the banking crisis that we had, it had nothing to do with credit. It was all just based on liquidity. So just the fact that depositors left was enough to create these problems in the banking system. So now, like that has not ended. Like depositors are still going to want to leave to go get money market funds at 5.5% instead of whatever they're making at their bank, which is usually close to nothing. And as that continues to happen, banks have, an asset problem that's too low, or their funding is too low, so they have to do something with their asset side. And the only thing they really can do on the asset side is to sell things, which probably means at a loss, which a lot of smaller banks are doing right now. They're selling off loan books. You can, or the security books, which, hey, a lot of that's like junky private credit and stuff that they're going to have to pull back on, which I don't know how that's going to look in the future, but it doesn't seem particularly good to me. But when all these default rates start happening, then the banks have to go, like our asset side's a problem too. So like all of a sudden, both sides of their balance sheet, both sides of their business are hitting them instead of just one. And one like created significant problems. The Fed had to, push hundreds of billions of dollars into them to kind of keep them going there. So how bad is this going to be whenever they're getting hit from their funding side and their asset side? I think it can be pretty bad, and they're already tightening up credit. That's just going to get worse. So if you want to get, borrow money from a bank, it's just going to be incredibly difficult, which at the end of the day is money creation. So your money creator is going to, step out of the game, while the Fed is also not creating bank reserves because they're doing QT. And the federal government is running a deficit, but the deficit next year is about the same as this year after the debt ceiling negotiations. So it's not incrementally going to be getting bigger, necessarily. So you get into a situation where credit and money are both a giant problem. And when money and credit are a giant problem, really bad things happen. Like it's just the way it is. And I think that's where we're heading back half of the year, early 2024.
Yeah, I think an interesting point on the banking crisis was let's say the concentration that those banks that went down, the concentration of how big accounts were at those particular banks.
Yeah.
In some ways that kind of creates a little bit of reassurance in that problem might not be bigger than it was, but I think to your point earlier, these lags start to affect all of these different markets very unpredictably and very variably, as the Fed likes to admit, right?
Yeah, and to your point, like for some of those banks that they're giant concentrated depositors, like that was the problem. Like obviously their interest rate risk played a role, but when you have a huge chunk of your money that just rolls out, like, well, game over.
Mm-hmm.
And a lot of banks don't have that problem, but at the same time, they all have credit risk, and they all have interest rate risk. That's just the business model. And if they both hit at the same time, like that's not good for banks. So I think even if you don't have banks blowing up the way we just did, what you have bank profitability problems, like really big ones, and you're going to have tight lending problems. And clearly, like when a bunch of people start defaulting on loans, like that's a problem for the bank that holds the paper. And we haven't even really had that yet. Like that's just started.
Mm-hmm. So Chase, exactly to your point, when that starts, when banks really start to tighten up their lending standards, especially let's say small banks, who does that start to affect most?
Yeah, so I'm glad you teed this up because it affects small businesses. This is an area where I think a lot of people, so like the young people is an area I don't think people are paying enough attention to, and small businesses. Usually, like you're thinking about a cycle, you're thinking about home construction, manufacturing, things like that. Like that's the stuff that leads you into a recession. But right now, I worry about young people just because their balance sheets are so bad. And I worry about small businesses because small businesses get their credit, obviously not from capital markets. They're not out selling bonds with, on a roadshow with Goldman Sachs. They're not selling stock. They're getting bank loans from the bank down the street. And the banks that are having the most problems right now is the bank down the street. So those are the ones really tightening up their lending standards. So if you're a mom and pop shop, just trying to sell some muffins or whatever, and you need some credit, it's really difficult. So I worry about really small businesses just having to go under because they can't get credit. I struggle to see anyone that's not just making bukus of cash flow and they need to borrow money. It's either you can't or it's at a penalty rate that doesn't even really allow for your revenue to drop. And obviously I think revenues are going to drop based on the rest of my macro call. So I'm very concerned, and 45%, I think about 45% of employment comes from small businesses. So if it's not like this is something where like, whatever, who cares, as long as Apple and Google are doing good and Amazon, like we'll be fine. No, if small businesses, go into recession themselves, then probably the whole economy does. And I think we're very close to small businesses kind of, if not leading us actually into recession, weakening the economy on the margins enough to let the rest of the economy pull us into a recession.
Mm-hmm. So I saw a headline the other day that was talking about banks needing to up their reserve ratios. Is that something that could really exacerbate this problem as well?
Yeah, it's unbelievable to me that this is something you would do now. That's something you might want to do, when you're coming out of this cycle and everything's getting better. It's just one. So lending standards are already tight. They're tightening. Banks are saying they're going to continue to tighten. The Federal Reserve or the Dallas Fed came out with a lending survey the other day and basically said that the banks in that region are like, yeah, we're going to keep tightening. If you raise those reserve ratios, they literally have to tighten lending standards more in order to raise that capital, or they have to fire sale more assets at a loss, whatever the case may be. All that's a problem. Now they've made it clear this would impact the smaller banks like less. This is really targeted at the big banks, but they have also made it clear it will trickle down to the small banks. They will have higher capital ratios, even if they're not the 20% higher that they're going to be for the big banks. I think we're to the point where the fragility in small banks and in small businesses is high enough to where it doesn't take much to like make this problem that much worse. As commercial real estate defaults, kind of keep stair stepping their way higher, that's just that much more pain for the regional banks. And as that asset side gets more and more impaired and they have to set aside more and more money, and probably more and more of their depositors are chasing money market funds, it's just one more grain of sand on this pile that we're creating that could just lead it to a little avalanche at any moment in the banking system, especially in small banks.
Yeah, as you're explaining that, it reminds me of reading a couple books about the Great Depression and how that problem really snowballed because of those policies that were implemented. I mean, arguably you could say this should have been done either sooner or later. Now might not be the right time, or when we come out of this. But thinking about that particular issue being implemented at this time, I totally agree. I think that ends up exacerbating this entire problem.
Yeah, it's one of those where you just feel like all these alphabet soup facilities the Fed is known for creating when things get bad, that I feel like they may as well get the Scrabble table out and get ready, because the stuff they're creating, like they're gonna have to create a lot of liquidity facilities, unless they just are gonna slash rates. And I don't think, obviously, I mean, they're about to raise rates next month, so obviously they're not in the mood to do any rate cutting yet. But I think this whole let's tighten rates and then like let's keep some money to throw at the people that have problems in the meantime is they view that, again, like they can't view anything like a system, but they view that as like, oh, it's two separate things. Like, that's fine. But at the end of the day, the banking problem happened and then they had to throw money at it while still raising rates. Well, when they threw money at that, liquidity went up and stocks went up. Everyone feels richer. People consume more. Like, well, I mean, your two policies are like absolutely at odds with each other. And money is so fungible, and liquidity is so fungible that you don't get to wall it off in one little section and like it won't bleed into others. So there's so much like schizophrenia in the policy right now, and I think that'll get worse, because if the real economy doesn't crack, but we get more financial stresses, whether it's banks or private equity or something, where like all of a sudden there's a big financial stress problem, they'll probably make a 4-letter acronym, the soup to throw at it. Here's, please go away. Here's $500 billion. Like, let us keep raising rates because core inflation's high. And you just kind of have this cycle where like you just keep doing that, and you're all you're really doing is starting the fire on the other end that you're trying to put out. So whereas you look at Europe right now, not only is Europe tightening, but they're actually draining liquidity, while we're boosting liquidity and trying to tighten, which doesn't really make a lot of sense. So, but that's what, I'm really bearish on Europe too, because they're doing both. But maybe they'll be able to get their cycle over with faster, because they'll actually start some fires that end the cycle.
That's an interesting way to put it. And going back to that idea, it's in some ways I think that has created a lot of reassurance for the market, considering that optically it looks like they did do a good job of being able to control the damage from that regional banking crisis. And again, going back to 2008, there were two different instances, one in March and then one in September, when the proverbial crap really hit the fan, right?
Exactly. And these are like really important signals whenever they pop up: credit stress, financial stress. Mm-hmm. And they're clues about the future, and you can take those clues seriously. You can investigate them. You can think about knock-on effects and what might happen next, or you can throw a few $100 billion at it and then keep going about your business. And my fear is that that's the choice they're making. And I really think it's because they think, they can just put regional banks in a cookie jar with a few $100 billion and it won't spill over. But to me, it's just not how things work. Like, I would say SVB and a couple of those banks, like, yeah, this stuff happened for a very specific reason. I give people that say that, like, the credit, like it's true. But I mean, go look at the chart of any financial, really, especially if they're smaller. They're still terrible, which tells me like, well, maybe something's still wrong. And I think you should treat those stresses very seriously, especially when zero credit risk played a role here. And that's what usually, gives a bank a problem. That's why credit's kind of leading this cycle instead of lagging, is because, you're already having to tighten up, financing conditions just because some depositors are walking out. Something I track and I've built is to look at the money that's leaving deposits and going into money markets. It's just the two aggregates. I don't know if it's literally the same money that's going, but if you just look at how much is going down in deposits, up in money markets, and then you just kind of look at the rate of change of that, and we're at extreme levels that always, precede big problems. We're like literally at the same levels that preceded 2008. So I'm not saying we're going to have another oh wait, I'm just saying that shows you like a bunch of money leaving the bank to go jump in the money market fund is going to pressure banks in a way that just has huge macro implications. If people can't borrow money, like things get weird because we're just a giant levered up debt-based economy. So not being able to keep that party going, I mean that stops the music.
Mm-hmm. Yeah, it kind of makes me think it's like a bucket with a bunch of holes in it. You only have, let's say, 4 hands to try to plug, let's say, 30 holes. You're always going to be constantly chasing that back around.
Yeah, absolutely.
To that point though, Chase, in one of your reports there, you were kind of alluding to the fact that you think that the Fed and the market might be wrong about the return to lower target rates than both are expecting right now. So why do you think that is?
Yeah, one of my favorite lines from the people on the other side of these debates from me is like, oh well, the SOFR curve's like it's already pricing in a recession. One reality is I think we're Fed fund futures, you look out, we're pricing in like 100 to 150 basis points in cuts. That's not what a recession would look like. You don't get to go from 5.5 back to 5 or to 4 and like that's a recession response. That's not how this would work. So that's not at all what the market's pricing in. The market's just having to price in the probabilities of, hey, maybe a little higher, maybe a little lower, maybe a good bit lower. And that all kind of triangulates to 1.25%, something like that in cuts. A real recession would be more like 300-400 basis points in cuts, probably. If you started a recession, but we're still scared of inflation, you let it just kind of really set in and start burning on a big scale for 3, 4, 5 months. Okay, well then you might actually have to go all the way back to 0, 1, something like that. And to me, like forget the trading side. Like you just trade whatever is going to happen. You just separate what you think and feel from all your trading activities. But just as a citizen and as someone that wants to see the Fed get things right and wants to see positive interest rates, it's just hard to watch them get this gift of what of COVID and fiscal to let them get off the zero bound forever. Because I think that's very bad for the economy. It creates a lot of long-term distortions that are bad. So to see them possibly ruin that opportunity and have to go back to zero because they over-tightened so violently after being so wrong in the other direction, it's just really frustrating. So I hope I'm really wrong on that, and they can kind of cut back to 2, and that's good enough. And then we can have a new floor under us that's 2 instead of 0. But I won't say it's a high probability event we go back to 1 or 0, but I worry about it because I'm afraid they're going to have the magnifying glass out to stare at core inflation instead of all the things that are going to be going wrong 6 months from now.
Mm-hmm. So do you think all of this culminates in the idea that demand destruction that the Fed was really after is arriving, but it all arrives all at once with all these other problems that it has manifested?
Yeah, I just think they had the lag wrong, so it's going to surprise them how bad things are whenever it like kind of all hits. I worry that it all hits sort of at once. That makes it tough, but I think what I really worry about is, I keep using the term too much in this interview, I know that, but the feedback loops, like whenever some of this stuff sets in, it knocks over other areas, and then it just kind of spreads, and then you can't do anything about it. So once employment gets to a certain level and credit gets to a certain level, you can't just jump in and cut rates and save it. Like it's gotten to a point where no, you got to let that thing's going to burn itself out. You know what I mean? You can't burn your way back. Like it's going to be a raging fire. So I worry about all those things where there's so many job losses that it does serious damage to demand. It does not only damage to demand, but damage to supply. Like I have some sympathy for the people that are saying like, hey, look, like you're raising rates so much that you're going to kill the supply side that can respond to inflationary impulses. Mm-hmm. I mean, look at Japan; they haven't cut rates at all, and their inflation starting to go, or they haven't raised rates at all, and their inflation is starting to go down. Whereas for us, like some of our inflation is because we raised rates. I think it's way more powerful on the bad side than that, and it will overwhelm it. But there is some inflation that is because we raised rates, like full stop. And there is some supply response that isn't going to happen because we've raised rates the way we have. So that's concerning as well. But yeah, my concern is it does all kind of hit at once, or that it just fires off so many domino chains that like it doesn't matter what you do policy wise because you already let the cat out of the bag. Horse is out of the barn, it's gone, and you're gonna have to wait for it to come back when it feels like coming back. You don't get to rescue it with policy. I hope that's not the case, and hope my fears here are unfounded, but I do worry about that.
Mm-hmm. So what do you think that means for commodity demand? I think you kind of touched on that about the idea that this kind of destroys the supply side ability to respond to some of this. So
yeah,
it seems like a real double-edged sword here.
Yeah, so I'm a commodity bear right now, cyclically. But because of everything we're talking about, I think this sets up for just a monumental long trade and just about everything, commodity wise. You think about, supply destruction and things like copper and oil in the last 6 months, probably the next 6 months. I think the only commodities you can be bullish on right now really are going to be agricultural stuff that just cares about weather and doesn't care what J-Powell's doing, or doesn't care about, a 1% move in Chinese demand's not going to make or break it. Like those are the kinds of things that can do well still. But commodities as a whole, industrial metals, oil, I think they're all going to have problems. Well, I take it back. I'm actually bullish nat gas, but again, that natural gas is going to care a lot more about weather than macro and monetary policy, at least Henry Hub.
Yeah, and I mean, at an absolute level, it's come down so much that if we have another cold winter, if Europe doesn't get the gift of the warm winter that they had, I think that is going to be a very tricky picture to analyze going forward, especially considering demand from manufacturing, right?
Yeah, exactly. And on the gas side, like I'm a bull, but because I'm a bear in the economy, like I do worry that the industrial side it becomes overwhelming to just the normal power burn side and stuff. But so far it's been decent. Although you look at in the U.S., you look at Europe and the industrial demand, man, the recovery there has been so tepid. It's a little freaky, but yeah, I mean, natural gas just makes too much sense as an energy source. So everyone's going to keep using it, and at sub $3 in the U.S., that's obviously too cheap. Obviously, you zoom out on the LNG numbers for, say, TTF and Europe, or even in Asia, like it's back to a reasonable level. It's still expensive compared to the last 5-10 years, but it probably deserves to be. So I think it's about fairly priced, maybe a little low. Rest of the world, and definitely too cheap in the U.S.
Mm-hmm. So you also included a uranium chart recently, and you were a little bit worried about if we get this, if and or when we get this recession, that gets hit alongside a lot of the markets here. Is that because of just this general liquidity issue that everything gets sold off, let's say including precious metals, in that basket as well?
Yeah, exactly. So I just think it would be a sympathy trade with the rest of energy kind of thing. That's my concern. But I'm a uranium zealot, so I didn't sell any of it the way I did. I had no problem throwing copper and oil stuff overboard for the most part, but with uranium, I find the fundamental case just so compelling that I'm willing to eat the drawdown and sit through it. But yeah, I do worry that you have a liquidity event and correlations go to 1 and oil's getting smashed, then uranium's gonna be like, well, let's go do that too. And on precious metals, like obviously they're struggling now. They're going to continue to, while liquidity kind of like stays a little lower here short term, and as long as nominal rates are up where they are. But whenever people start kind of accepting where the economy is and more importantly where it's going, you see, say, initial jobs claims get up above 300,000, stuff like that. Then I think precious metals are going to make a big comeback, and I think that happens in the second half of the year for sure.
Mm-hmm. I was also going to ask, are you kind of positioning in cash at this time because of that, your view of this looming recession?
Cash, but with leverage. So I'm perfectly fine messing around with SOFR, Fed fund futures type stuff, but also just the 2-year. Like the 2-year will pay you almost 5%, and if you have a recession, then you're going to get a bunch of capital gains from the price going up. So I think being in that 1 to 5 year range and on the treasury is a really good spot to be, because you get recession upside and you get paid a bunch of money no matter what happens. So on the yield. So the only way you can lose if yields go higher and pay you more at the end of the day. So that's something I appreciate a lot. I have a bunch of money in fixed income. And then other plays are kind of like shorts and betting against things I think are mispriced and are gonna have a bunch of problems. And then some longs and stuff like natural gas, uranium, some of the grains, things like that I think can just do well just for no other reason than weather.
Mm-hmm. Interesting, Chase. Well, that's a lot of what I wanted to ask you about here. Is there anything else that you think we need to touch on before we wrap up today?
No, I think that was really good. And I think we hit on all the big stuff that's been on my mind. So well done.
Of course, your writing is available at pineconemacro.com, and of course on Twitter at Pinecone Macro. Tell us a little bit about your work that you recently started at Bulwark Capital, if you can.
Yeah, I'm the head of research at Bulwark Capital. We're an RIA based out in Tacoma, Washington. If anyone wants to learn more about us, just check us out. It's bulwarkcapitalmanagement.com with MGMT, but you can just Google Bulwark Capital and you'll find us. We do things a lot different than most others. We have some unique strategies. We're a very active firm, so we're not just shoving people in some mutual fund stew and collecting a bunch of big fees. We have some unique structures that people may enjoy learning about it.
Excellent. Chase, thanks so much for your time today.
Thank you. Appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.